In this video, I'm going to talk a bit about some profitability ratios. So let's start off with the gross profit margin. So for gross profit margin, we look at sales minus cost of goods sold, which gives us gross profit, and we divide that by sales. So we're looking at basically what percentage of profit did we make from our sales, at least in terms of just the relative to the cost of goods sold. So if let's say we had $10 million of sales, and we had $3 million of cost of goods sold. So 10 million minus 3 million is 7 million. 7 million divided by 10 million is 70%. So we would have a gross profit margin of 0.7 or 70%. Okay. Generally speaking, we like higher as opposed to lower for that. Operating profit margin. Operating profit margin is going to look at my operating profits. So think my EBIT, so earnings before interest and taxes, so my operating profits divided by sales. So basically what we're doing is we're kind of working our way down the income statement, kind of seeing, we start off with sales and we look at, all right, here's my gross profit relative to the sales. And then I work a little further down, here's my operating profit relative to sales. And then we're going to get down to our net profit relative to sales here in a minute. So for my operating profit, I take my operating profits, or EBIT, earnings before interest and taxes, and we divide those by the sales. And again, generally, we'd like to see higher relative to lower. Then we get down to our net profit margin, and which is overall my net income, my bottom line net income relative to the sales. And again, generally, I'd like to see higher relative to lower. Now, a few little bits and pieces as it relates to that. So really, by kind of looking at the difference between the gross profit and operating profit, if there's a big gap there, that means there are a lot of operating expenses that are eroding the gross profit by the time you get down to the operating profit. And then if there's a big gap between the operating profit margin and my net profit margin, we've got various expenses there, like interest expenses and taxes and things like that, maybe one-time events that are eroding my profits between the operating profits and the net income. So by looking at the differences between these, you can kind of get a sense for where a lot of the deductions are happening on the income statement, and therefore what type of deductions are happening on the income statement. Now, I have noted already that generally you kind of want higher for these kind of profit margins and things, but there's a little bit of a caveat here. We do want higher, but we have to make sure we're keeping in mind volume as well. In other words, I need to actually make sales. So I could perhaps get a higher profit margin by charging more for my products. But if it kills off all of my sales, I only sell a fraction of as many items, I may actually be worse off as a company. So my profit margin may be higher per item, but then my sales overall may just crater. So you really kind of have to be a little bit cautious about that and be thoughtful about looking at the combination of the volume of sales relative to the profit per sale, and let's make sure that we're being careful with that. Now another way that I could look at my profitability is earnings per share. So this would be to take my net income available to common shareholders, which if I don't have any preferred stock would generally be pretty much my bottom line net income figure. But that's why there's a little bit of a distinction there. We have to make sure it is the net income available to common shareholders. So we've taken care of any preferred shareholders if they exist. And then I divide it by the number of common shares, and I'm finding out how much did the company earn per share. And that's kind of relevant because if you're a shareholder and you paid a certain amount to buy a share of stock, you own a slice of the company, and it's worth examining with your slice of the company how much profit was made, because you could want to compare that. That's sort of a way of looking at a kind of a return on investment. If I paid $50 to buy a share of stock, and if they made $2 of earnings per share, well, that's kind of like about 4% relative to, in terms of their profits relative to what I paid to buy the stock. So that's something that I could look at a little bit, get a sense for, okay, are they making enough money relative to what I'm paying? And that's actually going to lead to a ratio I'll talk about in a subsequent video, which is the PE ratio. But I'll come back to that in a little bit in a subsequent video. All right, so let's talk about some other profitability ratios. Return on assets. So for the return on assets, I'm looking at net income over assets. Generally speaking, we want a higher number here. I want to get more money relative to my investment, my assets overall. If it gets really low, that's not good. I'm not getting enough return. So generally, I want a higher return on assets. Then we have a return on ending period equity. This is the normal way that you typically will see return on equity calculated. So the return on equity is normally calculated this way. So net income over the ending period equity. So it's the common equity on the financial statements as of a particular date over the net income from the period ending on that date. So notice the income statement is still a period, the balance sheet is still at one point, but the points in time kind of, or ending points are kind of align here. And so basically I'm looking at the return relative to my shareholders' investment, okay? So return on assets is looking at how much money do we make relative to total assets. Return on equity is looking at how much did I make relative to my shareholders' investment. And generally, we would like to see a higher number here. However, there are some ways that you could get sort of the proverbial right answer of a higher number in this case for kind of the wrong reasons, perhaps. And I'll talk about that a little bit more in a subsequent video. But generally, we'd like a higher return on equity if we can. Now, it's worth noting that there's actually a little bit of, you could argue there's a little bit of a mismatch in this ratio. And the reason for that is, if you think about what happens from an accounting standpoint, every dollar of net income goes to one of two places, dividends or retained earnings, right? So it goes to those two places. So if it goes to dividends and retained earnings, if I'm looking at the net income for a period of time, and I'm comparing that to the common equity at the end of that period, so the ending date of that period, the common equity that's reported on the balance sheet at the end of that period includes retained earnings, which factored in the net income from that preceding period. So that kind of means if I earned a whole bunch of money here, it actually increases the common equity in the denominator through the retained earnings. And that's maybe not quite reflecting what we want. So if we're looking at the return on investment, you could argue that really maybe what I ought to look at is not the ending period common equity, but maybe the beginning period. In other words, at the start of the year, here's what shareholders had invested. Here's the net income they earned over the subsequent period relative to what they had invested. And maybe that's a better comparison. Now, for most businesses, probably the difference in calculating it those two ways would be pretty minimal, probably not going to make a big difference, and so forth. However, there are some calculations that may pop up at some point later, like if you're doing various sustainable growth calculations or things like that, where it might actually be important to have the return on equity calculated using the beginning of the period equity. And so that's why I have the return on beginning period equity. So this would be, for instance, if I took the net income over a fiscal period, and then I divided it by the common equity that was at the start of the fiscal period, then basically that would be the return on beginning period equity. And sometimes that will be more appropriate for certain calculations. But for the most part, generally speaking, if you're calculating just your standard return on equity, the way it's typically calculated is this. Although it's worth noting that technically these numbers are a little bit kind of interacting with each other in an interesting way, due to the fact that my net income figure actually directly relates to and affects my common equity figure in most cases overall. So that's kind of worth noting. Now, again, for return on assets, generally I'd like that higher. Return on equity, you want it higher, but it needs to be higher for appropriate reasons. For the profit margin, higher, but we got to make sure that we are actually still selling an appropriate volume of product. So hopefully that makes sense as sort of an overview of some profitability ratios. I'll add a bit more detail in subsequent videos. Thank you so much for watching and have a great day.